Equity refers to stock that is owned in a startup or company that is normally traded for venture capital, or people can purchase shares of the company. But it can also be given away in exchange for services provided that are needed at that time, and this is referred to as sweat equity. For new ventures, expending sweat equity can help save money, but it can also help to attract a team that shares your vision and that is willing to build the venture as they receive a part ownership in the company. Sweat equity is especially important for startups that do not have capital, which generally offer below the market salaries in return for equity in the company. Sweat equity can provide resources and talent that are otherwise unaffordable. Sweat equity compensates for the shortage of cash. Most founders of startup companies are often less privileged by the lack of funds to finance their activities. However, they dedicate their time to grow the company through effort and toil, which are rewarded back when the company becomes profitable. Sweat equity can also be considered as valuable as cash equity. Sometimes, large investors invest their money in small but growing companies with the potential to become large companies in the future. Note that employees who take a pay cut at the early stages are rewarded through stock options and ownership percentages that place them on the same page as cash equity investors. In real estate, some owners make DIY improvements on old houses and sell them at a higher market value than their value before the renovations. The key benefit of sweat equity is that it lets companies raise funds without raising debt levels. New companies are always met with challenges when raising capital, and obtaining too much debt may affect the business negatively. Sweat equity offers these businesses a platform to get free money by selling a portion of the company to investors. A proper accounting of that sweat equity is necessary to ensure that owners and investors alike get a clear understanding of the financial health of the company. Whenever splitting money is on the table, there will be concerns. Deciding how to distribute equity when starting a business is no exception, especially if you're not going solo but with co-founders. The question of splitting equity amongst them is bound to come up. Take it as an opportunity to have an honest discussion with all parties involved to avoid friction. The most important rules you should stick to when splitting equity are: Rule 1. Aim to split as equally and as fairly possible. Rule 2. Don't take on more than 2 co-founders. Rule 3. Your co-founders should complement your competencies, not copy them. Rule 4. Use vesting. Always. Rule 5. Keep 10% of the company for the most important employees. Rule 6. Don't start looking for funding too early. If you're a B2B SaaS, start only after your ARR, annual run rate, reaches 100K. Rule 7. It's better to get 3 smaller funding rounds rather than 1 big one. Rule 8. When looking for a seed round, don't give away more than 20% of the company. Aim for 15% as a perfect deal. In terms of sweat equity, the rule is if one of you works more and dedicates more time and effort, they deserve more. Therefore, a person who provides more value to the company via their skill sets, knowledge, and qualifications deserves more equity in exchange. Not every startup begins with piles of cash, nor does every startup get infused with angel investment money or venture capital funds. Sometimes, a partner who is willing to work hard, both through long hours and physical exertion, is exactly what a startup needs. However, sweat equity can be difficult to value accurately, and it is important not to overvalue it, though the value itself can be negotiable. The long-term commitment of the partner coupled with the long-term value of the sweat equity are what is most important to the startup company. The single most significant thing to remember in regard to sweat equity is to put it in writing. All the duties that are encompassed in the sweat equity, as well as the valuation and compensation, whether in stocks, salary, cash, et al., should be outlined in an agreement. This will ensure that all the partners/founders are in agreement and may also help the founders avoid disputes about the value of the sweat equity in the future. Not every startup company wants or needs a sweat equity partner. However, a sweat equity partner could be just what a bootstrapped company needs in order to move into the next phase of success.